At 1.8 times, this metric is fragile.
How you actually read a financial report determines whether you spot structural risk before your capital takes the hit. I'm Iggy, I run the numbers on SGX dividend stocks so heartland investors do not have to guess. My job is simple even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. We are breaking down the balance sheet, the income statement, and the cash flow statement step by step today using Keppel DC REIT as our real-world work example. Quick one before we get into it. Longbridge is running a special National Day promotion this month, and if you sign up through my channel, there's an exclusive $100 on top of it. Here's how it works. Deposit and hold your funds, and every day through day 9, you'll collect a piece of a top stock worth $6.10. On day 10, you get a shot at a lucky draw to win shares of selected US stocks worth anywhere from $6.10 to $610. And if your deposit hits $10,000, that's when the extra $100 cash kicks in. Full terms and the regular welcome rewards are both pinned in the comments below. Worth a look if you're already using Longbridge or thinking about it. All right, let's get into today's numbers. Most investors stop at yield. Keppel DC REIT's yield clears my 4.7% minimum hurdle, sitting comfortably above 5%. And I still can't call it a clean pass. The gap between a yield that looks fine and a report that actually clears is the entire reason forensic analysis exists. The sequence we are running applies equally to CPF, SRS, or cash portfolios. Your risk tolerance might change your personal decision, but the screening sequence never changes. The balance sheet shows what a company owns and owes, establishing baseline structural solvency. We check two hard gates here, gearing capped at a 35% ceiling and interest coverage ratio with a strict 4 times floor. Interest coverage ratio measures how comfortably operating profits pay the lender, not simply how much debt sits on the books. I always calculate ICR against gross interest expense rather than net interest. In a tight liquidity squeeze, lenders demand their full interest payment regardless of uncollected receivables. Keppel DC REIT's balance sheet gates both clear comfortably. Aggregate leverage sits at 34%, down 110 basis points after paying off a Tokyo debt facility. Trailing ICR is 6.9 times, which stress tests down to 5.1 times under a 100 basis point rate shock, easily beating our 4 times hurdle. A solid balance sheet is merely a snapshot of assets and liabilities at a specific point in time. It confirms solvency, but it tells you nothing about whether underlying properties are generating genuine operational income. That brings us to the next gate, checking if the earnings are real. The income statement reveals the true quality of top-line growth. Keppel DC REIT posted an 11.3% year-on-year increase in distribution per unit for the first half of 2026. Our job is to verify whether that lift came from organic rent increases or one-off accounting moves. Organic growth reflects durable net property income gains, positive rental reversions, and accretive acquisitions. Engineered growth relies on sponsor top-ups or capital distributions from asset disposals. Keppel DC REIT's H1 2026 growth was driven entirely by organic rent uplifts and the Tokyo acquisition, free of sponsor subsidies. Engineered yield looks identical to organic operational growth on paper until the temporary subsidies run out. Once that artificial support stops, distributions quietly drop. Keppel DC REIT shows zero reliance on engineered payouts this period, which is a clear fundamental positive. Operating disclosures hold the specific operating metrics that financial statements often gloss over. Portfolio occupancy dropped from 95.6% to 92.5% this quarter, breaching our 95% prime asset floor. The primary cause is a tenant vacating the Cardiff data center in the UK, leaving that asset vacant. Yield-only readers miss operational vacancies because headline financial statements mask single asset issues. The balance sheet still lists the physical property under total assets while portfolio-wide DPU still expanded. Only the detailed occupancy notes show that a building is sitting empty. Zone 4, caution, is the formal verdict whenever a core operating gate fails. Gearing, ICR, yield, and distribution growth all pass, but occupancy missed our floor by 2.5 percentage points. Discipline means acknowledging that red flag rather than ignoring it because the other gates cleared. A single gate failure impacts investors differently based on individual time horizons. If you have a long retirement runway, one vacant building with a clear releasing plan is a manageable operational risk. If you depend on every dollar of distribution for current living expenses, that same vacancy requires caution. The occupancy trap happens when an investor relies on backward-looking yield metrics. A vacant asset can take several quarters to pull down headline distributions. Tracking occupancy directly alerts you to operational problems before a distribution cut is declared. The cash flow statement is harder to disguise than accrual accounting figures. For REITs, operating cash flows generally track distributions closely due to mandatory payout rules. We review this statement to confirm that reported accounting profits match actual cash entering bank accounts. Cash divergence appears when reported net profits climb while operating cash flows stagnate or decline. That split usually indicates paper revaluation gains propping up accounting numbers. A trust can report strong accounting profits for months without generating usable cash for distributions. Keppel DC REIT shows no cash flow divergence in its latest disclosures. Operating cash generation fully backs the distributions paid, and the lower gearing resulted from an actual cash loan payoff rather than bookkeeping adjustments. Reading financial reports in the correct sequence prevents expensive mistakes. Check balance sheet debt metrics first. Review the income statement for organic growth second. Audit operational metrics like occupancy third, and evaluate headline yield last. Yield is the end output of business operations, never the starting filter. You are here because you value rigorous due diligence over market hype and speculative tips. Protecting your capital requires examining the actual numbers before committing funds. Platform algorithms only track engagement metrics like subscriptions and shares. If this forensic walkthrough gave you practical clarity, hit subscribe and share this with a fellow investor so high standard SGX analysis reaches more portfolios. Take this 4-step evaluation sequence and apply it directly to your existing holdings. The goal of this breakdown was to give you an objective screening process you can use across any stock in your portfolio. The 4-step process begins with testing gearing ceilings and interest coverage. Next, confirm that distribution growth is organic rather than supported by one-off gains. Third, inspect underlying operating disclosures such as occupancy rates. Finally, evaluate the distribution yield in full context. Running these 4 gates on your holdings gives you objective clarity. You will either confirm a clean pass across all 4 gates, or you will identify a hidden operational metric quietly lagging before market prices adjust. Monitoring the releasing progress at the Cardiff facility is the primary operational milestone ahead. Securing a quality replacement tenant would resolve the current vacancy and push occupancy back over our 95% hurdle. Balance sheet strength, organic income, and occupancy metrics work together to give you the full picture. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. Link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.